We're back. How's lunch?
That was low energy. What did you eat?
I don't know, green, some sort of, what did you get me? Some sort of green thing?
Yeah, Super Bowl or some
chicken
like that, yeah.
Episode number 3. Today we're talking about growth, cash flow, and balanced portfolios. So there's so many different strategies within property, building out a portfolio. And we touched on this on a previous episode. Like, it's very easy to get marketed some sort of way of doing things. Some people are very strict in one camp and only will buy one type of quality of asset. Others will buy the other side of things. And it's very easy to get caught up in, do I do growth? Do I do cash flow? Do we do commercial? Do we do this? Do we do that? And what does it look like? So we kind of want to walk through probably some of the pros and cons of each of the different strategies that are out there, and how your portfolio changes over time as well, how you might get, different things and ultimately land in a balanced portfolio, maybe have a mix, and just kind of walk through some of those things.
Yeah, I mean, historically, some people have just gone so religiously down one particular camp, e.g. like I'm team cash flow and all I ever do is buy properties that are positively geared, which is obviously extremely hard to find in this interest rate environment that we see ourselves in at the moment. And then on the flip side of that, you've got people who are purely buy growth. And when we say buy growth, we kind of generalize and say, well, lower yields associated with that. And we're here to kind of delve into that in a little bit more detail, maybe give you some of the pros, some of the cons, and then is there a middle ground? Can we potentially find a middle ground and a balance of?
It's actually a really good point. Like, what are the people that are pitching the cash flow positive properties now? Like, what are they? It'd be hard. Like, if you're telling people that you want to buy a positive cash flow property for them and then you can't find it, I don't know. It becomes
much easier 5 years ago or 4 years ago, especially when the interest rates were at high ones, low mid twos. It was a lot easier, but interest rate environment up in the sixes. Fortunately, at the time of recording, we're kind of talking around that 6, maybe high 5s. It's proving really, really difficult out there.
Makes hard. So we'll start with growth. So when we talk about growth type of assets, we're really looking at, established properties that have performed well historically. And generally they come under this category of blue chip type asset, which generally means that they're a really good quality property. They've stood the test of time. They've grown really well consistently over the last sort of 20 or 30 years. Generally, it's a bigger type of acquisition, meaning like more expensive. And generally, they're in markets that are considered, well-established, so capital cities, or potentially even regional areas, but, generally have a long history of, good demographics and careers and people working there and industries and everything else like that. So
I suppose one kind of delineation there would be, would you be saying that, say, for example, like a growth asset? Because we said we mentioned track record and history there. So we're kind of saying that established property rather than, for example, something newer.
Generally, I would only buy established. It's not to say that new properties don't do well or can't grow as well as established properties.
But you missed the track record part, right?
Yeah, that's true. So
it's a bit speculative, so to speak.
Yeah, that's very true. But it could, like, when we talk about new, it could be like, the previous property that was there on the same block has performed well over that time. And again, that comes down to like land versus building and materials. So, realistically, and this is probably a good thing to bring up with growth, is you're really ideally buying the block of land that's underneath the asset that you hold. Like the bricks, the mortar, the concrete, they all depreciate over time. Really, it's that land component that stays forever, and that's really what you're buying. So regardless if it is brand new or it is established, that block of land, you want to know that there's going to be demand for people to live on that block of land, whether it's new or old, at some point in time, and have that kind of true practice.
Yeah, age-old thing there that you can always change what the property looks like, but you can't change the location of where that property sits.
Correct. So some of the positive of buying these types of assets is it's one good quality property. You're not worried about multiple tenants. You're not worried about multiple property managers. You've got kind of one financial statement at the end of the year. You've got one sort of tenant that you have to deal with. And generally the tenants are of better quality as well, because they can afford these more expensive.
Without wanting to generalise and stereotype,
But, they can afford these higher value properties, so they're generally in a better, have a good career or some sort of income. I mean, there's lots of people with high incomes that don't have great careers, but you get the gist.
And I suppose even when you're kind of talking about these quote unquote blue chip locations, that's usually where you tend to see, if you're talking about kind of growth in a particular location, you'd kind of see it happen there first. And that maybe the price is a little bit more premium there relative to some of the outsider, maybe like the bridesmaid suburbs that obviously tend to grow, but maybe not at the same rate at which these more blue chip locations may do so. And obviously when you're kind of talking from a radius perspective, you might have location X, and then as you kind of further ripple away, the growth usually happens in that center point and then would ripple away further away from that kind of central point in through there. But like you mentioned there, in terms of the value of that property, so when we're talking about kind of a blue chip growth asset, like it's really hard to kind of say, because would you say that it has to be at an X amount of dollar point for it to be considered blue chip growth asset?
Well, the thing is, like, every market goes through its different cycles. So there could be a blue chip asset that hasn't performed well for the last 5 years just because, for example, somewhere like Melbourne has performed that well for that long. Like, it doesn't necessarily not make it a blue chip asset. So yeah, it's probably hard to categorize down to a specific thing.
Yeah, and it doesn't have to be a property that is $1.2 million plus is considered blue chip, because I'm sure there's plenty of $1.2 million properties that are not necessarily blue chip, and some that are 6, 7, 800K that might be considered a kind of blue chip, more growth orientated play.
Yeah, that's very true. Actually, that's a really good point. But I mean, generally, most people would say like, yeah, it's, a 1.2 is probably a good ballpark.
Yes. Yeah.
In like a, CBD, like one of the major hubs.
Yeah. I suppose like if you were to kind of throw a Bondi, obviously, when you say blue chip to me, I'm from Sydney, I just immediately think of Bondi. Not to say that it has to be Bondi and nothing else but it, and all the other suburbs around Bondi are crap by comparison, because absolutely not. But that's what I like, the types of locations. And I don't know if you want to throw a couple of other.
Yeah, I know. I mean, like Vaucluse would be like a major one. The properties in Vaucluse have outperformed pretty much every other market in Australia, I think. And so, when you talk about buying the best quality property asset, like if you could get into Vaucluse and like continue to have that sustainable growth, like that's probably the best thing that you could do if you wanted to have that type of strategy.
But now, so for example, Jordan buying that property in Vaucluse, what are the downfalls of owning that property in Vaucluse?
Correct.
Like, talk to me about what are some of the cons, because we can obviously all see what the pros are, right? You're buying an extremely affluent area. You're buying it at a kind of nice high price point. Your quality of tenant's going to be fabulous. You're probably going to get that long-term growth that you're chasing. But what are the not so pretty parts of owning this quote unquote blue chip property?
100%. Well, when it comes to property, it's all about supply and demand. And so, when you're buying at that higher price point, there's only a certain amount of people in the country that can afford to buy that type of asset. So, it may take a longer to sell for the right buyer to come across and pay the right price. Yes, there's plenty of, wealthy individuals, and maybe that market is so landlocked that like as soon as something comes on the block that it'll go. But, it's not accessible to everyone across the country. So it could take longer to sell if you needed to sell in or liquidate in some sort of situation. Also, generally what happens with those properties that increase in value quite high is the rents don't keep up pace with the value.
That's what I want to delve into here.
So you have that, the value of the property increasing dramatically, but the rents are only increasing at a certain rate. And so what happens over time is that rental yield gets lower and lower and lower and lower. And so you might, let's say it's a $10 million property, but the income might only be 1% or 1.5%. And so, you still got a 6.5% mortgage. So you've got to pay that, and you're only getting 1.5% in. 5.5% versus 1.5%, let's say. The value of the property is really high, which means when it comes to like land tax time and everything else like that, you're going to get assessed at that higher rate, which means you're going to be stung by higher land tax.
Needless to say, you actually have to come up with a deposit for that property, which is
correct.
Potentially going to be a little bit more difficult. Maybe that keeps you out of the market even longer if you were saving up to try and get to that blue chip higher price point.
Yeah.
And maybe the time out of the market has actually done you a disservice rather than getting it at a price point that you could actually afford.
Yeah.
And the common one that we always see is and you've already touched on it there, is the negative cash flow. Typically, where we're kind of talking about these higher kind of price point blue chip assets, it's generally associated with a poorer rental yield relative to some lower price point assets. And it's usually, particularly in this interest rate environment that we're in at the moment, it's usually a really strong negative cash flow position. Obviously, it depends on purchase price, deposit amount, interest rate, but it can be in the tens of thousands of dollars on an annual basis, putting land tax aside, just to actually make these mortgage repayments. So it's not necessarily that attainable for the everyday Aussie. For some people, it actually can form maybe a really useful part of their strategy. For example, we were only just chatting off air before, maybe there's a certain demographic of household incomes where they're actually on a really, really high level of income there that this asset might actually suit them really, really well.
100%. So, if you are paying a lot of tax per annum and you can reduce that tax by potentially paying this negatively geared property, which is an asset that's in your portfolio, you've got the growth of it, but you're paying with it with pre-tax dollars, that could be a really good saving or use of finances with the tax. So you might be in a position where it's actually a net positive to have a negatively geared property. But generally where we see a lot of people get stuck is they start to accumulate these really high, blue chip, high growth type assets. The yields on them are quite lower, and all of a sudden they're hemorrhaging, 40, 50, 60 grand a year. And for a general typical household income, which is 180 grand, sort of 200 grand, something like that, 40, 50, 60 grand is a lot of money. Even if you've got the tax deduction, you're only living off 120, 130, 140 there. And so, it's just something that you've got to monitor, something that you've got to manage. And if something dramatic happens, like what we saw pre-COVID, where interest rates increased quite dramatically, you could go from, as you were saying before, 2% interest rate to a 6.5% interest rate in a very short amount of time. Yeah. And all of a sudden you're unstuck because you can't afford to make those repayments. So when it comes to doing the plan and like strategizing out these things, it's always good. We have a graph on the platform, which is like +2 or -2% interest rates, and 2% probably isn't even enough. But when I talk to clients, I'm always like, make sure that you are comfortable with the repayments at +2%, because it could happen and you don't want to buy a property now for rates to increase in 2 years and go, actually, I can't afford this thing, then have to sell it and get hit with transaction costs.
And even with respect to the planning play, like, for example, if you're just looking at this one asset in isolation and you look at it and go, I can stomach that from a negative cash flow position, multiply that by the second property and then multiply it by the third property, and all of a sudden you're in this really uncomfortable cash flow position in today's interest rate environment. And yes, maybe the interest rates go down and all of a sudden our income goes up and we can stomach that, but we always just want to be preparing for the worst. And like you said there, run your maths, putting in some buffers, putting in some fat into all of your calculations to make sure that you can afford to carry these properties through the bad times. So obviously, yes, it's all well and good when things are going really, really well, but you want to make sure that you can hold these properties for the long term.
Yeah, spot on. Cash flow.
Yeah.
Pros and cons.
I mean, the pros, money. No, look, in terms of obviously the number one pro is that these things hopefully should be a lot easier to carry. And that's part of the reason why they're often kind of marketed as being positively geared properties, or which is actually, we're only just chatting about this, really, really, really difficult to find in this particular interest rate environment that we see ourselves in at the moment. But I mean, holding costs a lot lower, more attainable for the everyday Aussie is kind of one of the biggest pros that I can see.
Yeah, it makes the journey a little bit easier. If you've got that additional cash flow coming in, it might not be positive now, but at least you could be neutral or not as negative as something like a blue chip. Just makes the journey a little bit easier, a little bit more comfortable. You can ride those waves of interest rate movements and highs and lows, maybe even seasons of unemployment or something like that. It's definitely an easier journey. And so we often talk about this, but growth is what gets you out of the game long term, but passive income is what keeps you in. So, if you have and we'll get to this eventually, like a balanced portfolio, you can kind of do two different things, but you need cash flow to help you along the journey of building out that portfolio. Otherwise, you're just hemorrhaging year on year on year.
Yeah, you see so many people kind of focusing just in on one camp. And like I just mentioned in the previous example, that kind of $40,000, $50,000, $60,000 worth of negative cash flow is just unsustainable for most individuals. And even when we talk about cash flow, or higher cash flowing properties, they're at the moment usually negatively geared anyway, but it's just going to be a lot less of a burden from a holding cost perspective. And the other one thing there is that, and again, I know we're generalizing, but typically from a purchase price perspective, they're generally going to be a little bit lower than, for example, in our previous capital growth blue chip play. We're kind of talking in the $1 million asset. You might be able to kind of get into these ones in the hundreds of thousands. I mean, we're not hugely massive advocates of going out there and buying like $150,000 asset for argument's sake. So kind of setting some kind of baseline minimum as to what you're seeing out there in the market, but usually more attainable for the everyday Aussie.
Yeah, it's the reverse of what I was saying before. So, with the high growth properties, their growth rates have increased faster than rents. But in this scenario, the growth rates haven't grown as much, or rents have even grown at a faster pace for these types of assets. And so that value isn't as high as the blue chip. So instead of the 1.2 we were saying, you might be able to find 2 at 600, break that into 2. Maybe instead of a 1.5% yield, it's a 4.5% yield. And even though it still might not be net positive, it still allows that cash flow to keep going and keep rolling through. So it's just, again, makes that journey a whole lot easier.
Even just what you were saying then, right? Like, for example, if you were kind of coming through and saying, I'm going to jump up in price point now and say it was a $1.6 million asset, if you were kind of going that blue chip, maybe it's like if I throw Bondi back in there, it's probably like a 1-bedroom unit in Bondi. Maybe it's if you're lucky without parking, probably. But so you're kind of throwing all of your eggs into that one property basket, whereas potentially if you were to lower that price point down, still 2x8, $100,000, you're still getting into some pretty good quality assets here that some, or in fact many, would still call blue chip relative to that market.
Oh, 100%. And this is where, the concept of cash flow gets thrown around so much. And for me, it's probably anywhere from at least a minimum of, I'd say, like 4.5% yield, all the way up until 6.5%, 7% yield. But I think when you start to get above the 6.5% yield rate, this is where we can talk about probably some cons. Is when I, for example, was looking across Australia for my next purchase. This was years and years and years ago. I stumbled upon this little town in the middle of nowhere and the yields were 12%. And I thought I was some sort of property guru genius who's found the next location. But lo and behold, it was a mining town. And essentially what had happened there was, the mining boom happened. People were moving to that location. They were renting the places because they could work there. They were earning hundreds and hundreds of thousands of dollars because they're working in a mining in there. Fly out, fly out, fly in, fly out. And so the rents and the demand for rent in that location had gone so astronomical that they were so high relative to the value of the properties. And so if you're going really high into one category or the other, just be wary that it's not like a short-term play. So in the mining example, when that mining center, what do you call a mining thing?
Mining town.
Mining town, yeah. But where do they actually mine? Is it like a mining deposit?
It's a mine.
Oh, when the mine shuts down, the demand for rent in that location is going to come down with it. And so then not only will you lose rent, you'll lose less people that want to rent that place out, but then there'll be no growth in that area for a while because everyone's leaving the area, they're exiting the area.
Terrible stories about people who've lost hundreds of thousands in mining towns.
So supply and demand as per usual. And so, there's sort of a spectrum of what yields you can go through when it goes to cash flow. Just be wary of how far on the spectrum you go and the reason to why it's that high on the spectrum.
Yeah, really good bit of advice there. If we the other kind of thing with respect to the kind of 1 by X amount of purchase price, called the 1.6 and the 2 by 800 is that diversification piece. So, I mean, you've got one property in one market, which yes, when that market is doing very, very well, everyone's smiling and it's all fun and games. But if that goes through a bit of a stagnant period, for example, if you had 2 properties at say $800,000 each, you're diversifying into hopefully 2 different markets. So you're not I don't want to say overcapitalizing because maybe the whole 2 properties in one state or area might not necessarily be overcapitalizing. But if you were to deploy them into different markets while one's moving forward and the other one's sitting kind of a little bit more stagnant, then at least you've got some growth here. And then when this one's kind of slowing down, this one might be pushing forward. So you've got a little bit more diversity in terms of your asset allocation and maybe that lowers your risk.
And a common thing is how far down that road do you go? So when we talk about passive income portfolios or cash flow positive portfolios, generally it's people that have bought 5, 6, 7, 8, 10 of these really high cash flow properties, and they're okay to buy the 150s or the 200s because they've got 8% yields. They're really cash flow positive from the start. They can buy a number of these things because they still got the 1.6 that they can borrow. They just split it into 8 different properties, right? This is scenarios that we've seen. These are strategies that you might be talking about at the moment. And there's nothing necessarily wrong with that strategy if that's something that you want to go at. Just understand that at that 200K price point, it can definitely be a little bit more riskier. There's a reason that those properties are valued at 200K and haven't grown, and that reason might consist moving forward, and you might not see as much growth as you had hoped, but there might be some really good strong cash flow. And if you are diversified, then you're open to different markets. But when we see people start to get to those numbers of 8, 9, 10 properties, there is definitely an element of number of tenants coming into play, number of property managers coming into play. When it comes to tax time, you have to have 8 different statements. Generally at that lower price range, at every price range, things break within a property or something, if something happens with a tenant or something like that. But like, let's say a dishwasher breaks, you could have 8 dishwashers break in a month.
Hot water systems, aircon units.
Oh, exactly. And
even just when we're going to lunch, I just got an email from a property manager saying, what was it, the sink or something?
So, yeah.
The sink was blocked. Imagine you had like 15 of these calls coming out and completely resonates with you.
And it might not be like the end of the world. It might not be like very expensive problems, but if you're dealing with your job and then you've got a property manager calling you every 3 days because something's not working and then you've got to rush to fix it and tenants to keep happy and laws to abide by, it can become a burden, not necessarily an overwhelming burden, but it can become this thing where you're just like, oh man, it'd be so easy to have 1 or 2 of these problems. So,
yeah. But if that is your play, that's your play. Like if that's what you want to go out and do, and maybe finance dictate that as well. Maybe your finance dictate that is all you can get into. Maybe like for whatever that might be, $500,000, $600,000 is all that you can potentially get into. And is it this or nothing?
Yeah.
Well then, okay, maybe that's the case, or maybe you're going into it with this open mindset. But we want to really kind of paint the picture and be fully aware of all of the pros and the cons. We kind of spoke about one of the pros with that kind of higher value property there being a little bit more blue chip and maybe the quality of tenants a little bit stronger, the lower the price point. Again, not wanting to generalize, but maybe you might face some kind of tenant issues and rental defaults, property damage by tenants as well, high tenant turnover. So it's not necessarily always rainbows and roses within that higher cash flow route there.
Yeah, but I think circling back to strategy in itself, if you're sitting down and building out a plan and that's the only thing the way that you can do it and execute and build out a strategy, like by all means, like being cash flow positive from day one is very comfortable. Like you're not hemorrhaging towards the portfolio. You got money coming in. It's nice, even though you have to pay tax on it. It's nice to have money coming in from your portfolio and being like, oh, I made a little bit of money from that. An investment that I did, a year ago is bringing in cash. Like that can be quite nice. And if you stack that, and let's say it's $1,000 for one property, and then let's say a month, and then you've got 5 of those, it's $5,000 a month. All of a sudden, you're kind of like, oh, this
a lot easier to scale.
This could definitely replace my income at some point in time. Also, on top of that, and probably something that we'll get into, is if you've got an extra $5,000 worth of income coming through every month, well, guess what? That increases your borrowing capacity. Not by much. Don't get too excited. Let's say you're earning in that scenario like $60,000 a year. You would just times that by 6, which is what, Joey?
3,600. 360.
Which might be enough to go and buy another one of those assets. So you could actually add a property to the portfolio where you couldn't have beforehand. But you're not going to sit in the shoes that I did when I first started going, well, if everything's cash flow positive, I can just go and buy another one. Like everyone's still going to have a cap at some point in time. It's just that extra income's going to bring in a little bit more capacity where you could potentially go and buy another one or fit it in.
And I suppose if you were to categorize these as strategies, the one that I suppose most people will probably end up finding themselves into, but just maybe less popular in terms of doesn't get enough coverage because you have to be one camp or the other. The one that probably most people find themselves eventually might be that kind of balanced approach. And maybe you have a bit of a mix of these kind of more blue chip properties with a little bit of negative cash flow potentially associated with them and a balance of balancing that out with some assets that are higher in cash flow. Or maybe it's diversification in asset class altogether. For example, talking about and we'll do a separate kind of chat about this at a later date, the resi versus commercial thing. Why does it have to be resi versus commercial? Why can't it be resi and commercial?
Yeah. What we've seen actually work really well, and this is generally what happens with established portfolios. Like you buy that kind of fundamental blue chip type asset to begin with. That's generally the first purchase. If, you are listening to those types of podcasts and don't go down certain categories. Then you move into a second type of asset, which is what we call momentum, which is a bit of a combination of growth and cash flow. So still looking for at least sort of 6-7% growth per year. And then cash flow, you're probably looking at that 4.5 as a minimum type range. And you accumulate 1 or 2 of those in the portfolio as well. And then you generally get capped. Most people get capped at 2 or 3 properties. And then, you start to look at other ways that you can get financing. And there's this thing in commercial property called lease stock loans, which essentially means you can get a loan on the asset based on the lease agreement. The banks are comfortable with the amount of rent that's coming in to be able to give you a separate loan as long as you meet certain criteria, which means with a higher deposit, it might be like a 5-year, 5 year lease term or something like that, just makes them a little bit more comfortable. And then you go, okay, well, the only way that I continue to build the portfolio is get into the commercial type assets. And at the end of the day, you look back in your portfolio and you go, okay, well, it is balanced. Like it is a mix of all these different types of assets over the journey. And that's like where as we've touched on a number of times, like strategies do change over time. Things do pivot. Maybe there's things that get you capped where you're kind of like, I need to go and find different alternative ways of getting lending to be able to continue to build the portfolio.
Yeah, and it comes back to what we were saying before. Like, you don't have to necessarily be all about one camp. It might just be, one particular quote unquote strategy serving you for that particular acquisition, and then for property investment number 2 or 3, you might be talking about a different one, and then property investment number 4, you might be forced down that avenue of commercial because you are capped from a borrowing perspective, but you've got a really nice deposit, and that's the only option that's available to you. Or, for example, you could potentially liquidate the profits on one of those higher growth assets, and there's your big 40, 50% deposit on a big commercial asset that's going to go away and give you a really nice net return instantly from the outset. So kind of a couple of ways to blend them, and we generally see most people do that. Even you come into this whole property investing space with one particular mindset and one particular philosophy that you think you might stay down, and we see it time and time again how often that changes, and it usually does incorporate a balance of all of the above.
Yeah. And one strategy that probably only works with people that have really, really high incomes is like, what were we saying it before, is like one growth, one cash flow?
Pigeon pairing.
Pigeon pairing, right? So you go for one growth property first, and then you pair that with a high yielding property, and the growth comes out of the growth property, the cash flow comes out of the cash flow property, and they're kind of like put together. Why we don't see this work amongst everyday investors is everyone has their own borrowing capacity limit. So if you're going out and buying a commercial property and your first pigeon pair, you're maxing out how much you could potentially borrow. When you go to buy growth property number 2, there might not be enough left in the kitty to go and do that acquisition, right? And so what we generally like to see people do is buy their resi's property first, max out in a typical lending type environment, and then go and acquire 2 or 3 or 4 commercial properties because they can do that on lease stock loans. So don't pigeon pair and go, so I'll do one of those. So it sounds like a good strategy, right? Like something that I want to go and execute on. But if you're getting yourself into a commercial loan and then maxing yourself out and can't go and buy another resi, which was the plan, you just don't want to get stuck in that type of scenario.
And you kind of raise a really good point that slipped my mind a couple of minutes ago with respect to the whole kind of sequencing of acquisitions. So, and maybe that kind of plays into why you might choose one asset over the other. But if, for example, we were chasing growth, then why might you be chasing growth? Well, maybe you actually can't save a deposit quickly. And so maybe you actually are relying on the property growth and a bit of an equity extraction, a bit of an equity play to help you fund the deposit on the next acquisition. So maybe in that case, and obviously we have no idea what properties we're talking about here, but just being general, if we were to say the higher cash flow property had a slightly lower growth rate associated to it, you're going to then need to save up that deposit for the next acquisition a little bit quicker, because all the other things being equal, if the higher growth property had higher growth, well, then you're going to potentially get a higher capital appreciation to pull out equity to go again a little bit sooner. So that might help you in that accumulation phase, to your point, whereas the cash flow scenario, if it had lower growth associated against it, then you're actually forced to save up that deposit out of your own dollars in your back pocket.
And it keeps going. So if you're, just the growth type category, not a lot of people, but some people go down this pathway in the thought process that to cash flow, a bad environment or a bad scenario, I'm just going to pull out the borrowable equity of the growth that I've had and fund the negative cash flow. Now, on paper, it's a great thing to do because you're, pulling out tax-free income essentially, right? You don't have to pay tax on that growth that you've got, and you can cash flow the portfolio. But it's a very easy way to get unstuck as well. If there's no growth in that asset and you can't pull out borrowable equity and then you're in a negative position, you're going to get stuck and you can't fund it. You're relying on the market to continue to grow based on that strategy. We've definitely seen it work and it can be executed on. It's just a bit of more of a kind of a riskier play.
Yeah, definitely not for the kind of the unseasoned investor. Probably going to be undertaken by someone a little bit more sophistication and some years in the game.
So to wrap things up, let's probably debunk some myths. So when I first came into the game and learned about growth versus cash flow, I always had this assumption that cash flow properties don't grow and, growth properties don't have high incomes. But you can see a mixed bag. It's the same scenario that we were talking about with the growth scenario, right? You can buy the $1.6 million property and it might only have a 2% yield, and that's fine. But you could still consider 2 800K properties as blue chip.
Absolutely.
And they might have 4.5% yield. Same with a cash flow type of thing, right? So I always assumed, if there's a 6% yield, what I was showing you before in terms of the growth rate hasn't been as high. Well, that just might mean that market hasn't performed well for the last 15 years.
Period.
And lo and behold, in the next 5 years, it might actually perform really, really well. And Again, it's much easier for a 400K property to get to 800K than a $1.6 million property to get to 3.2 million. Can they both be achieved? Yes, but at that lower price range, you're more susceptible to everyone across the country. It's more affordable for everyone to get into. And so when there is supply and demand issues and there's more demand for these sort of 400K properties, it's very easy for people to like have more and more and more demand till it gets to 6, 7, 800K. And so you could have that doubling in value relatively easier than a 1.6 to 3.2, because again, there's only a certain amount of people that can buy and borrow for a $1.6 million property or have the capacity for a $1.6 million property. And unless there's some sort of like rush or demand for people to get into that particular area, it's harder to achieve as well. Not harder to achieve, but could take longer.
Yeah, and I think like to your point, right? So who's to say that a higher cash flowing property isn't going to be equally as, wouldn't perform the same from a growth rate perspective as a more blue chip property? I mean, I suppose if you were to come back and kind of just throw some rough numbers against it, your return, for example, if a $1.5 million property was growing at 5%, you're going to get a better return than if a $200,000 property grew at 5%. No one's denying that. But for example, if that 200K property did double in value, who's to say that? I mean, that's good growth, right? And it was positively geared from the outset and it doubled in value. You can't say that the property didn't grow. It did. But now I'm confused. So what is the right thing to do? Should I be buying high growth? Should I be buying cash flow? Now I'm very confused. Ron, please tell me.
It's, I think the answer comes down to, being able to buy what your end goal is, understanding what you want long-term, big picture. If it's to retire as soon as possible and step out of the goal, then maybe it is that cash flow scenario. Is it generational wealth and building a bigger legacy for, the family, maybe passing some properties over to kids, whatever it might be, then you probably might want to go down the higher growth camp. If it's to just have a well-balanced, established, diversified portfolio and, be comfortable with the cash flow coming in, but then also have some good growth, it could definitely be that balance, that mix of the portfolio. So really it comes down again to figuring out what that end goal is and then building the portfolio around it.
Yeah, and we see it almost daily where it comes down to the individual. Obviously, it comes down to what they're earning, what stage of life they're in. Maybe they're in the high income earning years and negative gearing is attractive to them. I personally don't think that negative gearing, it's just a state of play. It's not like a forever thing.
And that can change too, right? They can put in new tax legislation where you can't.
Exactly.
So it's just something to be aware of. If you're going down a very hard road on a particular strategy, that can change. It's just something to be aware of.
Yeah, absolutely. But for example, let's just kind of play on from that scenario there. You're in a stage of life where you're in your higher income earning years and maybe you want to negatively gear some assets, that's fine. But then as you're getting closer to retirement, all of a sudden the negative gearing isn't as attractive anymore because you'd like to taper down your work and then your whatever salary it was, 2, 3, 4, 500 grand isn't there anymore. And so all of a sudden, what are we negative gearing for? And then at that point there, as we're getting close to retirement, we're getting a little bit more cash flow coming through.
Yeah.
And maybe that's kind of coming in back and putting another vote in our balanced camp.
Correct. And it's okay to shift gears. As I said in the last podcast, I think, Steve Knight had 230 normal residential properties. I'm sure most of them were a mix, probably had some good yields and everything else like that. But he's just like, let's simplify. Let's get rid of them all, take the equity, and then just buy 3 commercials. Again, you're diversified in 3 different markets. They're probably at that higher price point, I can imagine. So, and this is a really good point to debunk some myths around the high growth versus cash flow, or the lack of growth on cash flow as well. Good friend of ours, and he'll come on the podcast, Steve Polisi was the one to quote this, but he was essentially saying, like, there's no possible way that you could have a residential property that's valued at $5 million an area and a property next door, commercial property next door that's valued at $500,000. Like, if you think there's no growth in commercial, you're completely wrong, because again, it comes down to the land component, and the land is what increases in value over time, right? So it's not like you're going to have lower growth or no growth in a particular type of asset. It just might be the seasonal or cyclical effect that goes through it. And so this is why we said from the first episode, like, your strategy can change, and it most likely will change. But you can't get to that point where you make a decision where you want it to change unless you build these things out step by step.
So we're saying that there is no one fixed strategy. It's fluid, it's ever-changing, it's dynamic. We just kind of want to put out as much content as we can, and we could speak for literally hours about this topic alone. We won't. We'll kind of wrap things up at this particular point in through here, but it's not necessarily a one-size-fits-all. It's not like throw all your eggs in one basket. It's more than likely going to be a balance of everything, particularly as your own personal circumstance change, and as job, family formation, other priorities, other goals change. But what we generally see is people would usually end up with a bit of a balanced portfolio overall.
Bit of a mix, bit of everything in a bag.
That's it.
Well, that's episode 3, guys. Thanks for dropping in, and we'll speak to you to the next one.
Thanks, guys.